Hello everyone. Mini Professor Olivier is back again. Are you ready for a new weekly analysis of financial markets? If you enjoyed this weekly video, please show me your support and like it below, you will make my day. So, let's start. The half-year performance stats are now in and they paint a pretty clear picture. The first 6 months of the year have been positive for equity and commodity markets, but tougher going for fixed income investors. Top of the leaderboard is commodities. The return of just short of 20% is extremely strong for just a half-year period, and reflects increased demand for both oil and industrial metals. Both, of course, are reflections of the strong economic recovery, as the world begins to reopen on the back of the mixed, but generally successful, rollout of vaccinations since the start of the year. Both oil and metals were starting from a lowish base, even 9 months after they had bottomed out, during the worst of the pandemic downturn last March. The Brent oil contract is now trading at around $75 a barrel, which compares with a brief moment at the start of last year, when oversupply, dwindling demand and a shortage of storage facilities led to a negative price for oil. Producers were literally paying others to take it off their hands. That naturally didn't last long, but when the price was languishing at or below $20 a barrel, few would have predicted that by the middle of 2021 it would have bounced to the current level. The talk has turned once again to whether oil is heading back towards $100 a barrel, and what OPEC can do to prevent that. Oil producers in that group, led by Saudi Arabia, like to keep the oil price high enough to maximize their revenues, but not so high that it starts to impact end-user demand, as famously it did in the 1970s, when 2 big spikes in the oil price sent the world into recession. The problem is that the members of OPEC all have different agendas and different financial pressures. Getting agreement on the appropriate level of output, and then policing it, is no easy task. The situation is complicated by non-OPEC countries who play more of a role in balancing supply and demand than they used to. And then, there is the political pressure from the US, which remains a big consumer of oil. Last week, OPEC and its allies, including Russia, failed to reach an agreement on raising oil production as the UAE in particular believes it has been asked to cut proportionally more than others. As the world's big oil companies look to diversify away from their core business, the UAE sees an opportunity to fill the gap and wants to pump more than Saudi Arabia and Russia want them to. As ever, the discussions are about much more than the economics of supply and demand, and the shadow of Iranian production, not to mention the strains of the relationship between the UAE and its big southern neighbor and muddying the waters. For now, it looks as if the direction of travel for oil remains upwards. Back to the half-year leaderboard, and second place goes to real estate, again a reflection of economic recovery and the collapse in values last year in the parts of the market hardest hit by the pandemic. Both retail and offices obviously had a very difficult year, and while property yields provide support to the sector, parts of the market face huge uncertainty about what the future will look like. Likewise, the boom in online retail during the pandemic is not about to reverse just because people can start to shop again, maybe even without a mask. The reality is that perhaps a decade of structural change in retail has been compressed into a year and a half. The way we shop has changed irrevocably, and high streets will never look the same. So, the 15% rise in rights in the first 6 months may be little more than a short-term rally from last year's 11% fall, which put property firmly at the bottom of the leaderboard for 2020 as a whole. The next places are all taken up by equity regions, as shares rose in the first 6 months across the board, albeit to differing degrees. Perhaps a little surprisingly, given its high starting valuation, is the continued leadership of the U.S. market. Wall Street was up 14% in the first half year, putting it ahead of global equities, up 11%, the UK and Europe, both up 11%, emerging markets in Asia-Pac, both up 6% and, bringing up the rear, Japan which is basically flat year to date. The East-West split in equity markets reflects a few factors: the relative success of the vaccine rollout in the West, America's greater desire to put the pandemic behind it and get back to normal, and a lack of ongoing stimulus in China, which pushed Asia-Pac equities to the top of the leaderboard in 2020, but which has looked less interesting this year. The bottom of the table is taken up exclusively by various flavors of bond, with government bonds the hardest hit, down 6%, as inflation fears raised expectations that interest rates will rise sooner than expected. Yields and prices move in opposite directions, so recovery and higher rates are bad news for the safest government bonds, which are determined solely by interest rate and inflation concerns, as there are no credit concerns with governments, which can always print money to meet their obligations. Corporate bond prices are driven by a combination of interest rate, inflation and credit quality considerations, so predicting their direction is less formulaic. In the first half year, they were dragged down with reference to government bonds, against which they are compared, but boosted at the same time by economic recovery, which means that investors demand a smaller premium, or spread, to invest in them rather than safer government paper. For both bond and equity investors alike, the Federal Reserve's decisions on interest rates and other parts of the monetary policy mix such as quantitative easing are key. So this week's publication of the minutes of the Fed's most recent rate-setting meeting will be closely scrutinized. The June meeting caused a wobble in markets, after the Fed admitted that inflation had been stronger than it had anticipated, and the so-called dot plots showing rate setters' forecasts of future interest rates pointed to an earlier-than-expected tightening of policy. Senior Fed officials have been busy since then, trying to reassure markets that they are in no hurry to raise rates and stressing the continuing uncertainty about the economic recovery, and investors have regained their poise. However, they have also been reassessing their conviction in the relation trade, which had seen a rotation, now partially unwound, from growth-focused shares to their more cyclical counterparts. Confidence in the recovery is not restricted to the U.S. In Europe, too, the European Commission is expected to raise its growth forecasts this week. Ursula von der Leyen, the Commission's president, said last week that prospects for the region were getting better and better. As the region catches up with the US and UK's vaccine programs, further lockdowns look less likely despite the spread of the Delta variant. Growth and inflation are central to the debate in China, as well as Europe and America, and on Friday we will get an update on the pace of price rises in the world's second biggest economy. In May, producer, or factory gate, prices rose by 9% and this month's increase is not expected to be much slower. Raw material prices have driven the index higher, and the focus now is on how much and when that increase starts to show up in consumer price inflation. Friday's announcement is expected to show CPI remains low at about 1.3%, with the government attempting to clamp down on prices to maintain living standards. That's all for this week. I hope you found this markets update useful. Please don't forget to like it below, and you'll make my day. Thank you very much again. I wish you all an amazing week. Goodbye.